Hi, it's Aaron here. So in this video, I want to share with you how to calculate the cash flow statement by using the items from both income statement and balance sheet. And we are going to identify the types of cash flow. And we have three types of cash flow here. We have operating activities, financing activities, and investing activities. So for my personal uh, habit there, I tend to separate them by using the calendar, and I think it's gonna help you to make less mistakes when if you are a newbie, in order to identify the items for calculating the cash flow statement, right? So I will give blue background colors for an operating activities items, and also the other colors for different for the other two type of uh, activities here. So we start with the accounts receivable. Okay, inventory, another current asset, and they are definitely the the operating activities related items, right? And then same for accounts payable and taxes payable, and then other deferred taxes as well. And then for investing activities here, I would just assume that short-term investments, it is the investments, okay? It's not like the marketable securities, which is the asset can be converted into cash quickly. So we just assume that, okay, that short-term investment represent the investing in the company's asset, something like that, right? So net PBNE as well, investment intangible. And then the last one will be the financing activities. That can be the notes payable, which is a short-term debt, and then the long-term debt, and then the common stock, return earning, treasury. These are related to the financing activities. Okay, make sure that we identify them correctly. So review it together. Notes payable. Okay, awesome. And gonna use the indirect method to calculate the free cash flow, to calculate the cash flow statement, right? So we add back the net income and depreciation as well, amortization, okay? And then I would say the changing accounts receivable and changing inventory, changing other current assets, right? And that's these three are from the asset section. And then we also want to say the changing accounts payable. And that's from liability section, right? And the changing taxes payable, right? And then the changing deferred taxes, okay? And that's the total cash flow from operating activities. And all we need to do is just sum up these items. Okay, now we jump onto the investing activities. I would say that's a changing short-term investments, right? And then the changing long-term investment. And then we also got Capex, capital expenditure, purchase. I would say the purchase is zero, but for this presentation, so I will just like show you the calculation, and it's the same calculation method for the Capex, right? Uh, I will show you later. The reason why I don't really want to include a purchase here is because actually purchase is zero. Because if you look at the intangible here, you see the current year's figure is actually lower than the previous year. That being said, the company didn't really use the cash to purchase more intangibles, right? So we were supposed to see the figures is zero. But for the calculation for the presentation, I will include it here, include it in these videos. And then I would say the from cash flow from investing activities. The final one is the changing in notes payable, right? Changing long-term debt, and these are financing items. The changing common stock, and then the dividends, right? And then the changing treasury stock. And that's the cash flow from financing activities. Okay. Now you might notice that actually we don't have dividend, and we're gonna find out the dividend by calculating the retained earnings, right? We don't have capex, we don't have purchase, so we have to do extra calculation here. So we're gonna use base analysis, the beginning balance, the addition, the subtraction, and then the ending balance, right? By the way, this should be the net cash flow by sum of these three types of cash flow activities. Okay. So yeah, we start with calculate to calculate the capex here. So we will say this is the beginning PBNE, right? And then the capital expenditure, the capex, right? And then the depreciation, and then that will be the ending PBNE, okay? And then that PBNE, and same for the purchase, right? The beginning intangibles, and then the purchases, and then the amortization, and that will be the ending intangible. Okay, and the last one is the dividends by using the retained earnings. So we say beginning retained earnings, add back the net income, right, and then subtract the dividend, and then the ending retained earnings. Okay. Now, do remember this? Like your current year's beginning balance of net PB&E should be the previous year's ending balance. Okay, so let's say previous year's ending net PB&E is here, and that should be the current year's beginning balance of net PB&E. Okay, capex is the only item that is unknown here in this calculation, but we know the depreciation you got it from the net income. That's the net income. You got it from the income statement, so depreciation. And your ending net PB&E balance is here. Okay. Now you do the reverse calculation by using the ending net PB&E balance. You add back the depreciation, but you subtract the beginning balance. Now that's your capex. Okay. So same for the intangible calculation, ending intangible should be your beginning balance intangible this year. That's the previous figure. Purchase, you don't know that, but you know the amortization from the income statement. Okay, your ending intangibles balance, you can find it on the balance sheet. That's the current year's figure. Intangible, right? If you use the ending, You add it back, add back the amortization, subtract the beginning balance, then you get 0. Okay. Your ending return earnings, that's from the previous years, 78. And that 78 should be current year's beginning balance. You add back the net income. You know that net income, you can get it from the income statement. And you know the ending return earnings of current years. So do the reverse calculation, ending return earnings, subtract the net income, subtract the beginning return earnings balance, and that figures is your dividends. Okay. Now we start. Go back to net income. We add back the net income. We add back the depreciation. We add back the amortization, and then we say for the changing account receivable here. For the asset section, we know we got 3 items. Okay, they're related to the operating activities. We will use the current years. I will use previous year's figures to subtract the current year's figures. If it is negative, that being said, it is representing the cash outflow, right? And that makes sense because for example, you see the increase in accounts receivable. That being said, you have more cash. More cash has been tied up in other business, in other companies, in other parties. So you want to receive your cash quickly, and that's the same concept. But when we were dealing with the operating working capital, right? You see the difference between these 2 years operating working capital. If you see that operating working capital difference, it's positive, it's increasing. Well, that means it's not a good thing for us. Okay, that's a no for us because we want to have free source of funding, right? We want to have more free sources of funds. So more cash that has been tied up in other parties is not a good thing for us. Okay, so if you see the inventory as well, if you see the increase in inventory, well, that means that we have more. We know we spend more cash in order to acquire inventory or purchase inventory, right? Other assets, well, we spend more cash to acquire the other asset, right? So that's why we see the increase figures. We spend cash to purchase this asset, right? To acquire this asset. But if you are going to the liability section here, accounts payable, then you need to, if you want to calculate the increase or decrease, then you need to use current year's figures to minus the previous year's figures, right? If you see the increase in accounts payable, well, that's good because we have more cash that is from our customers from other parties, and their cash has been tied up in our business, and that provide free sources of funds for us, and that's interest-free fund, right? So that's a good thing to us. And same for taxes payable because we still haven't used cash to pay for the taxes, okay, deferred tax as well, right? So for, like I said, so for the asset section, you use a previous year's figures to subtract the current year's figure. When it goes to when it goes to a liability section, then you do the reverse by using the current year's figure to subtract the previous year's figure, right? If you see the positive, then that's good. If you see the negative, that represent the cash outflow, right? So we start with calculating the change in account receivable. Account receivable here. So previous year's figure subtract this year's figure. Okay. So you see, and accounts payable. Current year's figure subtract the previous year's figure. Okay. Right. So for the change in deferred taxes as well. And that's your total cash flow from operating activities. Okay. And Same for the change in short-term investment. Previous figures subtract current year's figure that represent the cash outflow. And same for the long-term investment. Subtract the current year's figure. Do not include the net PB&E in intangible because that's not how you've calculated increase or decrease in these assets. Okay, you want to understand the capex. You just want to add back a capex and purchases, right? Do not just simply calculate the difference between these 2 years figures. Okay, for both the net PB and intangibles. Now you got capex. That's why we did extra calculation here. You got capex. Make it as a negative figures because that represents cash outflow. That is the reason why it is being called capital expenditure. Same for the purchases times 0, 1. Okay. Change in notes payable. Go back to the financing item. Because it's liability, so you use current year's figure to subtract previous figure. Okay. Changing long-term debt. Now you get more cash. You see the increasing the current year's long-term debt. You get more cash from your bondholders, and you get more cash from your shareholders, and that's your capital structure. Right? Dividend. You got a dividend. You need to pay out a dividends. And then you have changing treasury stock. Treasury stock means the company spend cash to repurchase the stock from the shareholders, and they put that stocks into the account called treasury stock. So if you see the treasury stock has more negative figures, that being said, they use cash to repurchase, to buy back the shares from the shareholders, and that's a cash outflow, of course. Okay, and that's your final figure here. That's net cash flow, 35,809. Okay, that's how you calculate the cash flow statement, by using the items from both income statement and balance sheet. And do remember, when it comes to reading the 10K or 10Q, you definitely want to check the note first, because sometimes some figures you need to clean up the accounts first in order to calculate the cash flow statement or income statement or balance sheet correctly. Okay, check the notes first always. I hope you enjoyed this video. See you in the next video. Bye.